Thanks for the reminder. Without further ado, we'll jump right ahead to investing post-COVID. Red Hawk Fund is a student-managed, student-run endowment fund, investment fund, which is a part of Seattle University's endowment fund. It was started on October 2009 with $250,000, and we currently only invest in US large cap equity, except for the utilities and energy sector. Our benchmark currently is S&P 500 fossil fuel free index, and our current team this quarter is um, has 17 student members. 5 of them are managers, as we just introduced, and 12 of the research analysts are also here. Our faculty advisor is Dr. Kathy Kao, and we also have a student advisory board, which includes the Red Hawk Fund alumni and also finance department advisory boards who are veterans in this industry. Here's a roadmap from where we began to where we are now. Again, our fund was founded on 2009, October. We bought our first equity on Nike on November 2009. And then our benchmark portfolio has been switched from S&P 500 to the fossil fuel-free version on 2018, along with the surge in the fossil fuel-free movement. And on 2020, we have surpassed $1 million in assets under management. Here is a chart showing the performance of the Red Hawk Fund from the beginning till last Friday. On the top left, you could see the total return being 381%. Our current balance as of last Friday is 1.1 million, with our 2021 year-to-date return being 7.3%, which trails a little bit on the benchmark portfolio of 11.76%, unfortunately. Primary reason being, as you can see on the left, our portfolio composition, we have cash being 10.7% of our portfolio. We are looking to invest those cash into equities and reach our target of 4.5% relatively soon. But in a bullish market, holding this much cash will result in a lagging return. Our IPS and investment philosophy starts with the top-down analysis with focus on fundamental qualitative and quantitative factors and emphasis on a long-term sustainable growth. And as such, ESG has been a center of our research lately. At a security evaluation level, the Red Hawk Fund uses intrinsic valuation such as discounted cash flow model and a relative valuation such as a market multiple model such as price to earnings or enterprise to EBITDA value. Again, a little more on the top-down approach. We start from the global economy and then local economy. We perform macroeconomic and sector analysis during every summer, every quarter. Then we go down to sector and industry, and then that's where the analysts are allowed to find and choose a company of their choice using Bloomberg Terminal, Morningstar, Value Line, etc. And then we perform industry analysis and competitive analysis. And then finally, the valuation methods comes in. Again, DCF and relative valuations are two very popular models used by our analysts. We have 4 steps on the asset allocation. The first starts with the goal. Our goal is to have high returns with low risk. Along with the goal, we identify the problems, which are market uncertainty and bias that comes into our valuation. To address those problems, we ask questions: how do we diversify our portfolio effectively, and how do we avoid bias in valuations? And the solution being, we would run quantitative model analysis and fundamental analysis. We also utilize this business cycle tables to identify the sector rotation, which are the cycles of the business would help us identify what stage the company is in and what stage would be the most profitable. Each year, we also run a performance attribution, which separates the performance into two pieces, allocation and selection. This is done every spring quarter, and we are planning to do a performance attribution very soon. On the Red Hawk Fund, we have team activities, and among the team activities, we have education, which includes member workshops. We had a very recent workshop on relative valuation. We also have a new member orientations, and those all gets posted on YouTube. For support, we have 2 open house hours every week and a portfolio manager assigned to every 2, 3, or 4 research analysts. We also have a repository of resources on our Teams forum. For community outreach, we have speaker events and company visits if the situation allows. Unfortunately, for last year and a half, we weren't able to do that, but as situation allows, we are going to hold speaker events and company visits. We already have some lined up. Also, this is the 5th investment series. If you have come to the past investment series, thank you. The one that I went to when I was not a member of the fund was the last in-person investment series, and ever since then, it has been virtual so far. Also, lastly, we also have an advisory board who provides numerous supports to the members. We have quarterly board presentations to the board members. We have insights from the student advisory board, and most importantly, we have ongoing mentorship from Dr. Kathy Cao.
All right, so before we compare the Red Hawk Fund's performance to major indices, I want to first recap briefly on the impact of COVID-19 on the stock market. So as you know, last March, COVID-19 fears triggered one of the worst stock market crashes in history. And the S&P 500 dipped nearly 34% in the month of March, wiping out 3 years worth of gains for the market. And this was very uncalled for many investors because we've been on a 10-year plus bull run prior to this. And volatility during the pandemic was as high as the 08-09 market crash, with so much uncertainty in the economy as everything basically came to a standstill. And even though the pandemic worsened in the months following March and the US economy sinking deeper into recession, thanks to the massive amounts of support from the Federal Reserve and Congress in forms of relief bills and stimulus checks, that limited how far stocks fell. And by August of 2020, the market recovered all of its losses and all major indices finished higher for the year, marking all-time highs all around. And when we fast forward to today, the positive momentum and optimism for full economic recovery continued, with the indices rallying even higher and setting new record highs almost every week. So now that we know how well the indices performed as of late, let's see how the Red Hawk Fund portfolio compares to it since the COVID-19 pandemic. One thing to note though is, as Chris mentioned, is that we're over 10% in cash in a bullish market, which is one of the main reasons for the underperformance in 2021. So first is the fossil fuel, S&P 500 fossil fuel index, which is our main benchmark. And since the pandemic, it returned a 38.7 or had a 38.78% return. And the Red Hawk Fund portfolio has been resilient in the initial downturn compared to that index. And we have been outperforming it in 2020, but has been trailing it by 4.1% in 2021. Next slide, please. So the next is the regular S&P 500, which the comparison is about the same as the previous, but the deviation from the benchmark is at a lesser extent. And lastly, the NASDAQ. So the Red Hawk Fund portfolio has been historically underperforming the NASDAQ as it's market cap weighted and is tech heavy. And as we know, a lot of the tech stocks has been rallying greatly as of late. And the performance difference between the Red Hawk Fund and the NASDAQ has widened, but the difference has been slowly getting smaller as the year progresses. And we hope to minimize this difference by deploying our uninvested cash in the next coming quarters. So next shows the S&P 500 returns broken down to sectors compared to our Red Hawk Fund portfolio uh, broken down by sectors. So as we see, we weren't able to get the data for the fossil fuel index, but instead we rather use the S&P 500 as the returns are about similar. And as we can see, consumer services has the biggest deviation and the greatest outperformance by the Red Hawk Fund portfolio compared to S&P 500 is the consumer discretionary.
In the communication services sector, currently the Red Hawk Fund holds two stocks, Walt Disney Company and T-Mobile. For T-Mobile, the catalyst of return would be increase in the 5G network and also the demand in increase in the 5G network. We are going to talk about Disney later on during the post-COVID market. In consumer discretionary sector, we have two of the highest returns, Tractor Supply Company and MGM Resorts. It is also a sector that we have outperformed the S&P 500 by the most. This is also the sector that we are expecting the most post-COVID effects. Our most recent purchase order for P&G was in the consumer staples sector. While we are trailing under the S&P 500, we are hoping that addition of P&G would bring us up and outperform the S&P 500. The financial sector is a sector that was the best performing year to date for both the S&P 500 and for the Red Hawk Fund. However, Berkshire Hathaway is under talk of liquidation due to IPS violation, especially for the fossil fuel usage. If we do liquidate Berkshire Hathaway, we are only going to be left with CME Group, which then the diversification for this sector is very necessary. Healthcare sector is also another sector that we have outperformed S&P 500. We are focusing on new business models such as telehealth and the vaccine effects. However, the makers of vaccine has not really had much returns because of the vaccine effect itself. Johnson & Johnson, Moderna, and Pfizer all had very different reactions after the vaccine has been released. We are still watching it very closely. For industrial sector, 2 out of 3 holdings that we have are in national defense industry, Lockheed Martin and Raytheon Technologies. Therefore, diversification is needed, and we are especially looking in consumer-related fields such as HVAC. For information technology sector, this is what we call the belly of the beast. We have very heavy concentration on Apple and Microsoft, both weighing 9.3% and 8.6% of our total portfolio. We are looking to diversify away from these 2 companies into cloud, security, teleconferencing, and EV application-related industries. Finally, we have materials sector. Currently, we hold two stocks on the materials sector, FMC Corp and International Paper Company. However, the International Paper Company seemed to be a little too risky for the Red Hawk Fund because its standard deviation on the return is way too large. Therefore, it is on the talk of liquidifying. However, again, if International Paper Company is liquidated, we are only left with one material stock in the portfolio, which calls for diversification. Here is a graph showing the total return versus of the Red Hawk Fund portfolio versus the benchmark. As you could see, we are trailing behind our benchmark, and the gap is the largest in 1 year. However, the gap is closing as we progress through time and is the least in 3 months, which means that we have trailed along on the first 6 months, but on the last 3 months, we are catching up to them. As Red Hawk Fund is a part of an endowment fund, we do our best to stay under a certain threshold of risk. And to measure risk, we use the standard deviation of the returns. As you could see, for all periods within the last 1 year, we have been under in terms of risk versus our benchmark. The Sharpe ratio, which is basically the reward to variability ratio, is a measure of performance based on the risk and return. As you could see, because our benchmark had a higher return, the Sharpe ratio is trailing. But again, as we go from 1 year to 3 months, the gap is closing, which means our performance has been increasing relative to the benchmark.
We identify 5 major changes in consumer behaviors that are expected to become popular in the year ahead. The first trend is online shopping. E-commerce business has surged due to government restrictions during the COVID-19 pandemic. 25,000 stores had to shut down permanently because of low store traffic level and profitability. When shoppers are vaccinated and return to stores, we believe physical store sale will improve, but at the same time, e-commerce won't be negatively impacted in the long term. Online shopping trend will continue as consumers are more comfortable shopping online. Therefore, consumer demand company to improve their search function, browsing flow, checkout process, and customer care.
Regarding our portfolio, COVID has accelerated the shift for many large retailers to direct-to-consumer sales. This affects our stocks associated with those that sell retail goods, such as Microsoft, Nike, and Apple. By selling direct to the consumer from the website, these companies save on retail storefront costs and make more profit per unit sold than if these items were sold from retail locations. Also, companies such as Nike and Apple are offering a wide array of customization for their products that can be done entirely online. We foresee large retailers having less of a need for expensive retail spaces and leasing out company-owned retail spaces to other companies for their own use.
The second trend is social and environmental responsibilities. The triple bottom line is an accounting framework that many organizations have adopted to evaluate their performance. It includes 3 factors: profit, people, and planet. Coming out of the COVID-19 pandemic, organizations are demanded to focus beyond their profit. As the world simultaneously fights the pandemic and try to mitigate damage to the biosphere caused by deforestation and pollution, we believe consumers will increasingly consider social and environmental issues. How did the company protect the health and well-being of their workers and communities? What initiatives have been taken regarding the climate change concerns? How the company addressed modern-day slavery issues and generate renewable outputs? Those are some of the questions that we believe consumers are paying attention to.
When the global economy shut down, pollution levels throughout the world also went down. Areas traditionally choked by smog opened up and the populace could see a blue sky for the first time in ages. Thus, a great discussion is being had about companies and the pollutants they emit and who is ultimately responsible for them, the consumers or the companies themselves. A lot of companies in our portfolio have pledged to go carbon neutral, carbon negative, or to entirely fuel operations with renewable resources, such as Apple, T-Mobile, Microsoft, Intel. But other companies will need to be more aggressive with their environmental targets and take a leadership role in environmental stewardship, lest they draw further negative attention to themselves, such as Coca-Cola, Colgate-Palmolive, and Procter & Gamble.
The third trend is travel. We found that international flights have been declining, primarily driven by a European travel ban that the Trump administration put into place in mid-March. But domestic air travel are increasing. Even though domestic air travel has quickly recovered as people are vaccinated, we expect tourist spend to reduce as personal disposable income won't be at the pre-crisis level until next year.
MGM Resorts International is the only stock in our portfolio that is related to restaurants and travel. While MGM's share price did not suffer because of the pandemic, and in fact, it was one of our highest performers, we are expecting the end of lockdowns to boost interest in their hotels around the world. Because MGM Resorts provides a full entertainment and hospitality experience, we expect demand for its services to increase during the economic recovery, and that in the short term, for business to boom.
The fourth trend is health awareness. As of April 25th, there has been 32.1 million COVID-19 cases and approximately 600,000 deaths in the US. 32.5% of American adults are overweight, and another 36.5% of adults are obese, causing a high mortality rate due to increased risk of cardiovascular disease, cancer, and diabetes. Consumers are pursuing fitness such as yoga, Pilates, and at-home workout to shield themselves from getting the coronavirus as well as other diseases.
Our health-related stocks have done really well this past year. Medtronic, United Health Group, Johnson & Johnson, Cerner Corp, and Stryker Corp, and provided solid returns. However, once COVID becomes less of an issue, we do expect less aggressive results from this sector. Many new healthcare startups have made an entrance during COVID with remote doctors, also known as telehealth. We find it difficult to predict the future performance of these startups, but believe that more established healthcare companies will incorporate these new technologies and processes into their offerings platform.
The fifth trend is about movie or entertainment. We observed that tickets sold at the US and Canada in 2020 was 224 million, which was only 18% that of 2019. We expect the demand for movie theaters to remain low due to permanent theater closures and the shift to digital channels. Besides, major movies such as Justice League, Tenet, Godzilla vs. King Kong, and Wonder Woman has been released via streaming. Therefore, digital channels are expected to outperform traditional movie-going experience.
Regarding our portfolio, the Walt Disney Company has been partially flourishing under the COVID economy. While they did suffer losses from theme parks being closed, their visual entertainment division has been generating and releasing new content like clockwork. Between Marvel and Star Wars, the Walt Disney Company owns a significant piece of modern pop culture and has enough interesting material to keep pumping for the immediate future. With Disney taking full control of Hulu in 2024, the Walt Disney Company will expand its share of the streaming marketplace and slowly chip away at the long-established behemoth Netflix. So in conclusion, the past year has provided an uncertain investing environment that we have, all things considered, done well in. We will need to diversify certain sectors. Other sectors require further analysis to assess past and future performance. It's been said, both as a blessing and a curse, may you live in interesting times. Well, times are certainly interesting, and we here at the Red Hawk Fund are well poised and excited to help invest in the future on behalf of the Seattle U Endowment. We are now welcome to take any questions you may have. Thank you.
Thank you. Any questions from the audience?
Yeah, I have a question.
Yes.
I think that it was today or yesterday, the census released their data on population growth, as well as the aging population in general of the United States. How did you assess that with regards to your recommendations? I mean, how did you price that data in your recommendations?
Population is a very interesting thing. First of all, in our direct valuations, it pretty much directly affects the terminal growth rate, which is the usually taken by the long-term GDP growth rate or long-term inflation rate. And those GDP are basically driven by population. And as population growth, well, the growth of population is increasing, we are expected to see a little more terminal growth by these companies. And as they decrease, it would on another hand decrease. And if we look only in terms of the United States, the population growth, well, the population is growing. However, there are certain parts in the world that are experiencing severe population decrease, especially in East Asia, like Japan and Korea. So the way we incorporate population growth, and we would most likely put it in our intrinsic valuation.
Yeah, I mean, actually, what you just said is not correct. The United States has had, in this period, the lowest population growth since the Great Depression. And in fact, the United States is more and more an aging population, which would kind of inform your healthcare. You mentioned that the healthcare grew a lot, but after COVID, you didn't expect that growth. It is very important for you to look at the latest trends. And since this census data just came in, it is impossible for that to be reflected in the GDP yet. So, so for future, that would be very, very, very important. And I acknowledge that maybe you haven't seen that data, but that would be my recommendation to you, because that would support some of your recommendations and maybe change them a little bit. Now, the second question I have is that you mentioned that you use the S&P divested by fossil fuels. At one point, you used the data of just the plain Standard & Poor's with energy weighting, right? So why didn't you use the data of that fund that you're looking at? I mean, you said that's not available, or you cannot calculate it, or how did you use it? And finally, you kind of mentioned that there was not much difference in the returns of both funds. So what led you to believe that with regards to that?
So to answer your first part of question, yes, the S&P 500 fossil fuel index did not disclose its by sector performance. So we had to find the proxy for it, which then became the S&P 500 itself, because that was the closest proxy that we could find. To answer your second part of the question, the reason why we believe the S&P 500 is the closest proxy to our benchmark is because it includes the stocks that we don't have, but any other benchmarks that are out there does not reflect the S&P 500 fossil fuel as well as the S&P 500 itself. Or that's what we believed.
I have a question.
Sorry, I had a question in the chat, so I'll address that first and then I'll get to you. Kurt asked, what considerations does the fund assess and act upon for companies that are due to decline in the coming periods? Not suggesting shorts, just wondering. So, Kurt, first of all, thank you for the question. We are not allowed to short a stock. And the reason why we are not allowed, or I should say, the reason why we are only allowed to purchase a large cap US equity is because the Red Hawk Fund itself is a learning experience where a student could learn how to value a stock and perform financial modeling on these stocks to come up with a price. That is why we are not doing short. But considerations that we make upon companies that are due to decline, first of all, the companies that the analysts choose to value is up to them, and it is completely up to them. But we also do a rebalancing of our portfolio. So if we hold a company that we believe are going into a recession, or we think we are not going to do well, we identify them and then we try to perform a valuation on them and decide whether we should get them out of our portfolio or not. And vice versa, if we are looking at a stock to buy and if we happen to stumble upon a company that looked like it's going to decline, we just simply don't buy it. I hope that answered your question.
Fantastic. Thank you, Chris.
Thank you. Next question.
So I saw you mention ESG. So beside to ESG, what other criteria that you use to make selection on company you want to invest in each business sector, such as financial ratio or earning per share, something like that?
Lindsay, do you want to take over this?
So this quarter, because of the ESG trend, we focus more on the ESG and have the ESG section in the equity presentation. Beside ESG, we also look at the company business model, the industry that the company operates in, as well as some of the financial approach, such as the what Chris mentioned in the presentation, that we use the DCF model and the market multiples approach. Chris, do you want to add something more?
No, what you said was completely right, and yeah, I think that wrapped up our approach very nicely.
So I noticed when you were reviewing the benchmark slides, I noticed you haven't outperformed out of many of benchmark. Do you have any plan for increase your return in next year?
So a couple of aspects to that. First of all, as we mentioned, we were holding too much cash on a bullish market, and that was because most of the trades that happened before 2020, and we only have one current order placed to purchase P&G. Again, the reason behind that is because the Red Hawk Fund is a learning environment. We have to go through a rigorous process from the valuation itself to the order. So to briefly mention this, once an analyst performs a valuation and presents in front of us and has a buy rating, the managers come in and then look at the Excel, look at the valuations and see whether they are all correct and sound. And after that, we consult with Professor Kathy, and then in between Kathy and us, we talk about it and then see if this can really add value to our portfolio. That would be in terms of return or in terms of risk. And then after that, we decide how much of the portfolio are we going to purchase the stocks for. And then all after that, we send a market order or a purchase order to buy a stock. So it's a very long process. For example, the P&G that we have put in the order last week, the valuation was done last quarter, and we just recently put the market order in. So it is a long process, and that is probably the biggest reason why we were trailing behind in 2021. Another aspect to that is, again, the risk component, because our endowment or our fund is a part of the endowment fund. We are striving for lower risk, and usually for a stock to have a higher return, they also come with a higher risk. We have a dedicated risk manager in our portfolio manager to identify the risk of investing in a particular stock and whether that could really add value to us. And because, again, International Paper Company was deemed too volatile, we were actually thinking about selling it. So there are these several reasons why we were lagging behind our benchmark, and it's kind of a fundamental problem. But I don't think a investment just for a return is helpful in a learning environment, which is the major goal of the Red Hawk Fund.
All right. So for my understanding, so your criteria weigh more on the ESG criteria than the financial return, because you want to invest more on the those socially responsible firms. Is that correct?
Not necessarily. ESG is a criteria that we just recently put in and have been evaluating, because usually better ESG means a company can have a more sustainable business, but having a sustainable business really isn't everything in terms of business. We do weigh a lot more in the financial analysis. For example, if you stay till the end of the meeting, you'll get to hear our analyst present on Microsoft, and you can see how much financial analysis that goes into that. ESG will be just a little part of that.
And Nancy, just to add on to that, this is a Jesuit school, and the faculty are very focused on social justice, and so we're trying to incorporate some of that same awareness and respect towards social justice in our evaluations. It is not the deciding factor, but it is certainly a factor.
Ah, good to know. I feel grateful that it didn't put you on pressure for getting more return on your portfolio.
Yeah, I just have a comment. Joe, that was great. And by the way, I'm asking all these hard questions, not because I want to trip you, but because I want to prepare you. These competitions are brutal. The questions are, really, really, really tough. And you need to learn how to react and answer intelligently and right. So I'm going to continue on this trend of kind of pushing you here. Isn't the ESG already priced in the discount rate that you're using? In other words, that beta should be reflecting, or even the cost of capital that you're using should be reflecting that ESG, or on the other hand, you think that it's not reflecting that ESG, and therefore it should be incorporated in the discount that you're using. And within that, one of the questions that you always get in a competition is, what is your discount rate? How did you get at that?
Right.
And you have not really touched that. I mean, cash flows, whatever, but it's really the fundamental thing is that, and different from what you might think, every analyst has their own secret, the secret discount rate in which they incorporate their own risk assessment. So if you can elaborate on that, that would be great. And Joe, good answer about the Jesuit thing. That was really good.
Thank you, Professor Kimbrough. Your questions are really great, and I'm learning so much from it. To answer your question about the ESG incorporated in the discount rate or data, I wouldn't know much about whether it's being reflected in beta itself, but I do agree to you to a certain degree that it would be incorporated in the cost of capital, being a company's cost of capital. Well, a company with a sustainable business will have lower cost of capital. But I don't think a cost of capital fully reflects on a company's ESG. For example, a company can have a horrible environmental aspect or a social aspect, but can be generating so much cash flow or have at least a certain sustainability of business that the bad ESG doesn't hurt their business. Yes, I was actually just gonna go into Apple. Apple was one of my example that I was going to use. Another company that just comes to my mind is DuPont Chemicals. But I am also interested in hearing other managers' thoughts on this. Does anyone else want to talk about their
I wanted
opinions?
to thank you, Chris, for explanation. I wanted to add on to Chris's point. So yes, beta and the discount rate incorporate some of the ESG aspect, but we wanted to have these aspects into our like presentation, so we know every aspect of it, because if it's in the discount rate or in the beta, we don't really know what is in it. It's just a number. But we have our IPO, and we wanna invest in the companies which are doing usually ethical movements. For example, we have been going into Walmart over and over if we want to invest in it, or if you want to do the valuation in Walmart. But we also didn't want to invest in a company who is treating their employees really badly. So we have to consider also ethical manner into companies. That's why we wanted to include ESG, so our analysts can deep dive into it, how they do these things, what they do in their business operation in terms of ESG, so everyone can know better about their standards about ESG. So it's not only quantitative matter for us. We want to know what they're doing and how they're doing. We just don't want to invest in the company for return. We want to do it right. And like Joe said, we care about the justice, social justice.
Yeah, I think that's a great answer. Another thing that I am concerned in this presentation in general is that, for example, you haven't talked about the environmental plan of Biden, which is huge. I mean, the investment that it's going to be in everything, clean energy, all that stuff, it's so huge that I think that the market has absorbed and priced already those things, but you should, really show. I mean, Joe knows how much I stress that you need to read the news the first thing in the morning before you read your texts and your emails. You need to know what's going on. And that stimulus package and those initiatives that are going to go through, by the way, must support your move towards ESG, right? Not to mention that the SEC today is looking at ways of looking at that closely and requiring disclosures on ESG. I mean, just look anything today and you're going to see how the SEC is moving in that direction. So yes, the answer of we're a Jesuit institution and all that is beautiful and it's great and it must be there. But there's also a lot of factors that are coming down the road that would support that, right? So, so if I were going to give you an advice, is read the newspapers and read it of what happened today and yesterday. And if that means that you need to change your PowerPoint presentation, do it. But that is what's going to effectively give you that edge, right? So anyway, I'm not gonna torture you anymore.
Thank you, Professor. Just want to mention that this was just a little overview on our past performance and future plans, and that our analysts do incorporate factors like the new infrastructure plan into their individual analysis, depending on what sector they're in. But I was in industrials last quarter, and the Biden plan was definitely part of our analysis. So, and we do tend to read the news, so we're pretty good about that.
Right. There's, again, as you said, this was meant to give you a high-level introduction of what we do. a more deep dive of what we do will be presented by our analyst later on today on his valuation on Microsoft. So please watch out for that. Are there any more questions from the audience?
Maybe just a crosstalk question, which are all news sources equal, and should there be more of a focus on a particular place to go for news? Just
So
Facebook's probably not it.
yes, right. All the Red Hawk Fund members have access to Bloomberg Terminal, where we usually which is our primary source of data, including the news. I do know that some of our members have subscription to Wall Street Journals, New York Times, etc. I personally do too, and that's what I use the most.
Yeah, I think on that issue, each analyst has a personal preference, although everyone uses a mainstream news service. I like The Economist, Wall Street Journal, then the New York Times. And I'm sure other people have their own rankings, but that is a good point to make sure that we're all standardized on what is and is not an acceptable news platform.
Right.
Can I ask a question?
Yes, go ahead.
So when you evaluate a company, like I guess like how do you guys split your portfolio depends on the risk involved with each company? I don't know if that makes sense or not, because you know, like let's say like Microsoft is a lot more stable and safe compared to like a new startup.
Definitely.
But yeah, kind of things like that. I don't really have like the exact like example, but yeah.
So well, first of all, us being limited to investing only in large cap kind of limits our ability to go more than like slightly risky, I would say. But you're right, even within large cap, there are more risky or more cyclical industries than others, such as biotech would be much more cyclical than, for example, a brick and mortar store. As we have mentioned previously that this fund is a part of endowment, we do have some expectation of having lower risk than most other portfolios. So if that answered your question.
Yeah.
Cool. Great.
Thank you.
Thank you. I think I have time for one last question. If not, we will jump right into the Kahoot. This is my first time using this, so let's see. I'm going to share my screen real quick. Right, can everyone see the screen?
Yes.
Yes.
Cool. If you want to participate, you could go to kahoot.it and then enter the game pin 923451. Please put your first name as the name so we could identify who's who. So if you win, the prize goes to the right person. The questions will be based on the presentation that we just had, and there will be 15 questions, 30 seconds each to answer the questions. Questions number 10 and 15 have double points, so even if you're trailing, you still have chance to come back, so don't give up.
Can you tell me again how to do this?
Yes, if you go to kahoot.it it will tell you to type in a password.
Okay, so I need to download the app or just go
You don't
to a
have to
website?
download the app. Yeah, you can just go
Okay.
to the website kahoot.it. Has anyone not been able to come into the Kahoot? Joe, you're not allowed to play. All right, I think this is it. I'll go ahead and what happened? Oh. Cool. I will lock it now and start. Question number 1, what 2 asset types have the Red Hawk Fund held until today? Stocks and bonds, ETF and bonds, stocks and ETFs, stocks and T-bonds. The answer was stocks and ETFs. The first stock that we purchased was Nike, and we currently purchased large cap equities. And before that, we have held ETFs on S&P 500, SPY. The current leader is Ray. Next question. When did the RHF buy our first stock? September 09, October 09, September 010, or November 9? The answer was November 09. September 09, Red Hawk Fund was not found in September 09. Red Hawk Fund was founded on October. Number 3, which number is the closest to Red Hawk Fund's current portfolio value? Lots of quick answers for this one. Majority of you got it right. The closest number was 1.1 million. Thomas is still in the lead. Number 4, which company did the Red Hawk Fund submit the order to purchase in spring 2021? Apple, Colgate-Palmolive, Procter & Gamble, or Pfizer? Lots of quick answers for this one too. Yes, the answer was P&G, Procter & Gamble. Thomas, still in the lead. Which equity is the Red Hawk Fund looking to sell due to its IPS violation? International Paper Company, Apple, Johnson & Johnson, or Berkshire Hathaway? Two seconds left. The answer was Berkshire Hathaway due to the fossil fuel free index. Which of the following methods is not used by the Red Hawk Fund? Bottom-up approach, DCF and relative valuations, macroeconomic and sector analysis, or industry and competitive analysis? The answer was bottom-up approach. We use top-down approach. We start from the general economic and then move down. Which sector was the best performing sector for the Red Hawk Fund on 2021? Condesk, financials, IT, or materials? The answer was financials and was the best performing sector for the Red Hawk Fund and S&P 500. Thomas is still in the lead. Next up, which index did the Red Hawk Fund underperform against in 2020? S&P 500, Nasdaq Composite, S&P 500 Fossil Fuel Free, or Russell 1000? The answer was Nasdaq Composite. S&P 500 and Fossil Fuel Free were both Red Hawk Fund both beat on 2020. Next up, which two companies have the highest weight on Red Hawk Fund portfolio? Nike and Microsoft, Costco and Nike, Costco and Apple, or Apple and Microsoft? The answer is Apple and Microsoft, 9.3 and 8.6% of the whole portfolio, respectively. Next up is a double point error. Which of the following is not a consumer behavior change as mentioned during the presentation? The answer was telehealth services. Telehealth services was not a consumer behavior that we mentioned. It was something that we were keeping an eye on for healthcare stocks, but not a consumer behavior change. Ryan is in the lead. Number 11, how many COVID-19 cases has the US had until 4/25? 10, 20, 30, or 40? The answer was 30 million. Ryan is still in the lead. Number 12, which of the following stocks does the Red Hawk Fund hold related to travel/restaurant rebound? MGM Resort, McDonald's, Chipotle, or Alaska Airlines? Those are pretty quick answers. MGM Resort and Hotel was the only stock that we hold related to the travel restaurant rebound. Which of the following is not a part of the triple bottom line? People, property, planet, or profit? The answer was property. People, planet, and profit were all part of the triple bottom line. Tina's catching up. How many stores have been permanently shut down during the pandemic? Time is up, and the answer was 25,000. Last one, double points. Which sector was the highest performing sector on year-to-date 2021? Info technology, consumer discretionary, industrials, or financials? Financials was the highest performing sector. Thank you all for participating. I will announce the leader after the presentation. Up next is our analyst presentation. Al is a research analyst in the Red Hawk Fund. He is earning his bachelor's in business administration, and he is going to present on Microsoft. Al, are you ready?
I am. Just a
Great.
second while I get things started.
Go ahead and share the screen whenever you're ready.
All right, and then, cool, am I visible? Should be. All right, hello, how's it going? My name is Oliver Vasquez, here at the introduction. I'll be evaluating today Microsoft Corporation, ticker symbol MSFT. Of course, this is the day for today. All right, here's a bit of an overlook on Microsoft. To keep things short, I'm looking at a target price of 284, representing an upside of 8.81% with a final buy recommendation. And there's a few reasons, or several reasons, why I'm putting this forth. First on the left, you can see Microsoft compared to the S&P 500, and you can see it's been outpacing it pretty well. Of course, it is an IT company. But even among IT companies, I think it's rather exceptional. And those three reasons are listed below, which is its rising cloud business and gaining some massive market share in terms of its cloud business. It has a massive portfolio that's very well diversified, as I'll go into briefly. And it's also a very innovative company. It spends a lot of money in R&D, which has been very beneficial in terms of some rather lucrative deals that I'll go over momentarily. Okay, cool. Let's touch on the company overview. So Microsoft splits itself up into 3 different sections. The first is the intelligent cloud. This is their Azure service, GitHub, Visual Studio. Then there's the productivity and business process here in the center. This is your Office suite, your LinkedIn, your OneDrive. On the right here, we have our more personal computing. This is the last section, as they call it, consumer-facing computing, essentially. This is your Windows operating system. This is Bing, and then this is, of course, Xbox and Surface. These are some interesting areas to touch on, especially right now. And I'll get into some implications about, the silicon shortage and everything on this last section, because it's kind of interesting to touch on. But they've actually represented some pretty substantial areas of growth. And this year especially, it's pretty interesting because, of course, they've just unveiled their new console, the Xbox One X and the Xbox Series X and the Xbox Series S. Okay, and here we have our revenue by segment. Okay, you can see why I like this company so much, and that's because things are split up nicely throughout. We have 34% of it going to more personal computing, intelligent cloud 34%, representing a pretty major growth from the past, and there's productivity in this process as well, sitting at 32%. This is a very well diversified company. And that's one of the reasons for why I was leaning on a buy recommendation, is that it has wonderful diversification, and its intelligent cloud is growing substantially. It's made some pretty major deals and acquisitions that I think will also be very helpful there. Okay, there you go. That's why I was kind of freaking out a bit there. Okay, you can see things spaced out there. I see Joe laughing, but you can see the revenue as well from each segment. And you can also see why Microsoft is pursuing so much on the intelligent cloud, is because it represents a large portion of the revenues. It's quite lucrative, and it's also part of why other companies such as Amazon, which is currently the big market leader in terms of the intelligent cloud, is so keen on using it. Is because it essentially is able to subsidize the rest of its entire company using just the intelligent cloud. It's why it offers such great deals in terms of Prime service. Talking about a different company right now, but it's important here because that's what Microsoft is aspiring to do with its intelligent cloud. So there on the right is why the word there. Forgot to put that animation in. Okay, more company overview here. Again, speaking more in terms of diversification of Microsoft as a business, we see 49% of Microsoft going into international revenue, and then we have 51% of it in the United States. Again, nicely diversified in terms of what we want to see between national and international revenue. All right, I talked a lot about deals and acquisitions and implications that I had for Microsoft. Here's a little bit of that. All right, first off, we have a deal on the left side here. Microsoft is not acquiring the US Army. The United States Army, this is a $21.9 billion deal that has just advanced. It was originally, half of it was essentially not going to move forward through the Senate. It was going to be frozen. But this is going to move forward. And this is basically through their AR technology with HoloLens. This is a massive deal for Microsoft. And I was talking about how much money they spend on R&D and how innovative they are. And this is where it pays off in terms in those investments. One, of course, you're going to see some really great products from them, but also deals like these are another area where you can see Microsoft pulling in a lot of revenue. Okay, let's talk about the two big acquisitions, the elephants in the rooms. There's first of all, Nuance. This is a pioneer and leading provider of conversational AI and cloud-based ambient clinical intelligence for healthcare providers. This is a nice step forward for Microsoft in terms of their Internet of Things technology, moving a little bit into the healthcare business here. This is a massive acquisition valued at $19.7 billion, all cash. I also want to note another one that happened here very recently. This involves Microsoft entering the industry IT as well. So Microsoft is making many acquisitions, again, building up its intelligent cloud and its Internet of Things, trying to gear for the future. Another thing that I'm going to talk about here is ZeniMax Media. If you're not familiar with ZeniMax Media, they make video games, and they make some of the largest heavy hitters. We're talking Elder Scrolls, the Fallout series, really big games. This was valued at $7.5 billion, and this could be very important for Microsoft as they in their gaming service. I say service because even though, of course, they have their consoles, the big thing they're pushing on here is, again, building that cloud infrastructure, using, for example, Game Pass. They haven't been using exclusives on their consoles. Instead, they've really been pushing Game Pass. They're playing the long term here whereas Sony's obviously focusing on the console. Microsoft's focusing on the future of what gaming might look like, it being a subscription-based model. Just as it's turned other of its its other products into subscriptions, such as, for example, its Office Suite. This is another great area where they can turn it into more lucrative and consistent revenue growth. Okay, cool. Let's move forward into the industry as a whole. And here's where I'll touch on silicon as well. We'll get there in a second. The first thing is competitive rivalry. Suffice to say, Microsoft has a lot of competition. I would mention that it's trying to grow its intelligent cloud, but of course, Amazon is still the leader in that end. We have big companies like Google, Facebook, the other giant tech conglomerates that are still in the way. And Microsoft is constantly competing with them, trying to obviously get more and more of a lead and succeeding in terms of Internet of Things. But this is an area where they obviously have their work cut out for them. Threat of new entrants has been mostly minimized. As it works here, whenever there is a threat that's up and coming, it's typically acquired, kind of like Microsoft has been trying to acquire Discord, though talks fell through. That is said to still be on the table for the future, potentially. Bargaining power of suppliers. This one's an interesting one. We're in a certain place where we're seeing a pretty massive silicon shortage. This is especially impactful for Microsoft and its gaming business, because basically Apple and other companies that are ordering larger bulk silicon-based devices are going to have preferential treatment. They're going to have to be prioritized. And Microsoft's consoles and Surface systems haven't quite seen that priority, and so we're seeing a lot of lost revenue in the sense that Microsoft isn't able to ship out all of these consoles. Sony's seeing the same thing, obviously, but it's something to mention. Bargaining power of suppliers is actually a little bit higher than it typically is, despite the fact that Microsoft has so many different suppliers on the table. Oops, that's unintentional. Okay, then we have the bargaining power of buyers. Rather low, largely because of its Office Suite and its other services that are in some ways kind of necessary in the industries that they operate in. Then we have the threat of substitutes, which again, this one is a little bit higher. Because although the threat of entrance is low, threat of substitutes from either companies acquiring a new product, bringing them in, like any of the larger tech companies, this is a threat that exists there. And so this is a potential constant threat that Microsoft has to face, again, from these other big tech companies. They're always on the table. Cool. Let's move on to global share of cloud infrastructure. Here on the right, you can see, again, Amazon at 35%, Microsoft at 20%. What you don't see is where it used to be. And that was Microsoft sitting at around 17%, and Amazon at 33%. Amazon, I think it was 36%. So Amazon's share hasn't really shrunk much at all, but Microsoft has begun to bite into the rest of the competitors, and it's kind of inching its way towards the dominance that Amazon has been able to set up for itself. And it's doing this primarily through its Azure, Microsoft Azure service. So this is the big area that Microsoft is trying to push forward through. Here on the left side, we have the global share of cloud infrastructure services previously. So this is what I was referencing before. And you can see how much Microsoft has grown here. Amazon actually hasn't changed. Apologize for that. But Microsoft going from 15% all the way to 20%. Again, substantial jump. Okay, and here it is. Here's Microsoft and how it's poised in terms of its market share in computing software. We see Windows still taking up 62%. Mac OS X has actually grown a decent bit, but it has cut into Microsoft's share. But of course, Microsoft still holds a demanding lead on this end. This is going to be interesting to see, as well as competitors begin to move into ARM-based devices. So you saw Apple unveil their M1 chip. Microsoft has had ARM for a while. Windows on ARM has been a thing for a few years, but it hasn't been great. And Apple really kicked it off really well with their ARM version of Mac OS and their Apple M1 chip, which has been really good. And so while Microsoft was previously trying to compete there in terms of service devices and gaining little to no traction, this is likely going to be a big push in the industry as a whole, Microsoft included, to begin to double down on their investment in ARM because of how beneficial it already has been seen to be in terms of power versus performance, especially for mobile devices, which will be especially helpful in the future. And in fact, Microsoft, kind of like Google, is thinking about creating its own silicon. So there's talks in terms of Microsoft having Microsoft Silicon, Google's doing the same, Apple has obviously been doing this for a long time with their A1 chips, their Bionic chips, M1, etc. And Microsoft wants to get into that instead of having to depend on providers such as Qualcomm. Cool. Let's talk about valuation. Here we have the WACC going into it. We have a rather high WACC, largely in part. Well, let's break things down first. So we have the methodology on the right side here, 22.25% in terms of the 30-year Treasury bond, 14.03% in terms of the return that we've seen the S&P 500, 193 beta, and then cost of debt 2.16, cost of equity 13.25%, and effective tax rate of 17%, up a little bit from the previous year, leading us to a final WACC of 12.71%, rather high. Now, there's a global growth rate in 2021 at 5.4%. I've loaded this in terms of the future, and the reason why is because we're estimating a pretty large rate as we kind of open up the economy for the very first time. And this is something that I see not necessarily sticking into the future forever, because as the pandemic comes out, eventually the market will begin, I think, to cool down, and that leads to our terminal growth rate, which is somewhat in line with that previous estimates. Okay, gross margin by segment. This kind of continues to hit home again in terms of intelligent cloud. I spoke a lot about why Amazon is doubling down so much on its intelligent cloud and why Microsoft is doing the same, because of the return that you see. And more personal computing doesn't quite have that return. And every single year we see the share of revenue in terms for Microsoft moving more and more towards intelligent cloud and productivity and business process, and away from more personal computing, which largely used to be Microsoft's butter and bread. And we can see here how that's shifting. Okay, investment and risk. This is kind of a big one, and I wanted to bring it up recently because of some pretty major acquisitions that Microsoft has made recently, and that's Americans' opinion on breaking up big tech. This is also not a partisan issue, as you can see, which is kind of rare in America nowadays. But we can see here support rather high in terms of breaking up big tech, and Microsoft is included in that. And as acquisitions continue, whether that be the ZeniMax Media, whether that be or whether that be with more consumer-facing products, such as the Discord acquisition that was being attempted by Microsoft, that might continue, especially as a lot of resentment towards big tech, especially on the social media end, continues to grow. Microsoft might at some point find themselves in the crosshairs. And this is a major investment risk that we're looking at here. Finally, it leads us to our ESG over time. Microsoft is actually one of the highest rated companies in terms of its ESG, ranked at number 7. And we see here where it sits in terms of its different scores. Environmental ranking quite high, governance ranking very high at 70, social disclosure score has dropped a little bit, but it's still doing relatively well, leading us to an overall very solid ESG disclosure score. And again, one of the highest companies, period. And for that reason, again, pushes me to say Microsoft is a very good pick in terms of being a fit for our fund as we continue to focus more in terms of importance on ESG going forward. Okay, to finalize things, here you go once again. We're starting at as of today, 261.55 actually. I saw the closing price, and then we're looking at a 284.23% target price, then 8.81% upside, and a buy recommendation. Again, for the several reasons that I mentioned. There you go. That's my final recommendation. Thank you so much. I appreciate you sitting on to my presentation, and I will now open up for questions.
That was really great. Made it within the 15 minutes, so thank you. Really great presentation. So I guess my question is what do you see as Microsoft's competitive advantage against AWS? How is Azure going to expand its market share of the cloud computing network? Why would someone want to change to Azure from AWS?
There's a decent amount of, I would say, recent. AWS has actually been stagnating for the past few years, and Microsoft has been has been growing their lead dramatically, largely because of the prices they're able to offer, a little bit of political resentment on AWS, as well as some services that Microsoft has to back itself up, specifically centered around its productivity and business area that helps prop up Azure over AWS. And I think that's the reason why Microsoft has seen so much growth, while AWS is kind of stagnated, as have some of the other competitors. In fact, the field has narrowed a lot, as you saw from the graph. There used to be a lot more companies that I was willing to show there. But it's narrowed a lot in recent years. And that's largely because Microsoft has picked up a pretty good portion of the market share.
Thank you. Second question. So it's my understanding that Microsoft as a tech company has the highest rated bonds for the industry. What is the strategy for this? How do you see this being to their advantage? Will they keep it that way? What are your thoughts on that?
I think they will keep it that way. And yes, you're correct. They do have the highest bond yields in the industry in terms of in their respective industry. And I think that's especially beneficial right now with a lot of people being more risk averse to speculative investments. Microsoft's going to seem like a much more, I guess, fruitful place to go and a much safer place to go in the current climate.
Thank you.
Al, two questions. First of all, how much revenue does Microsoft get from outside of the US?
It's quite literally about half and half, 49%. And so if we look at their most recent, and so in 2020, we saw Microsoft get a revenue of, and this is in millions, 100. But we're at sorry, I'm like struggling to find a file. Okay, it's half of the revenue essentially, but as I mentioned, 49%. So
does Microsoft have any ways to hedge against the foreign currency risk?
I'm not too sure on that end, to be completely honest with you. Yeah. So
also, Microsoft just made it's kind of old news now, how fast things are going, but Microsoft basically bought a large game company and have essentially became a part game company. Do you think that's going, or how did you put that into your cash flow forecast?
That's going to be very important. And I actually, game revenue actually grew by 64%.
Right.
So it's now making up a really substantial portion of their personal computing. And it's going to be more important going forward because there's a lot of unrealized revenue that Microsoft has that it hasn't been able to foster because of the silicon shortage. And so, yeah. So to answer your question, I think it was a great acquisition. I really do. Especially with what Microsoft is doing in terms of trying to bolster the value of its subscription service in terms of Game Pass. I think it's going to be really good. And so it's obviously been in the industry for a while, but this, doubling down and trying to answer, the biggest criticism to Microsoft, of course, in the past was that it didn't have exclusives or it wasn't quite as invested in terms of its own IP. This is going to resolve that issue and bring Microsoft a lot of value and hopefully a lot of demand.
Thank you.
I got a question I want to ask. So recently they're having a talk about the Microsoft want to buy Discord. Yesterday, I believe they did not go through a deal. And like, what do you think? Did they miss out the opportunities that able to have a better, gaming plus like a social platform? Do you think they miss out a chance, or do you think it's fine without acquiring the Discord?
There's a little bit of bias in my answer in a second. I'll give it to you, but just to say things, there's a bit of bias. Yes, they missed out. Discord is an amazing company. And I say that because there's not much of a replacement there. There are a lot of, substitutes in theory, in terms of communication platforms that offer chat, that offer video, but none of them quite have the reputation that Discord has. And none of them are also seen at the same light that Discord is seen in. It has a very different sentiment and feel to people. And I say that in terms of my personal experience with it, in terms of other people's personal experience with it. But it would also fit nicely, especially if Microsoft was, able to subsidize. I'm assuming they're not, they're obviously a private business, but I'm assuming they're not generating much of a profit. They have a Nitro service, but not a lot of people use it. It's not a lot of money. So I'm pretty confident they're running at a loss. And so if Microsoft were able to subsidize that, or and through its acquisition, and try to offer a similar product, and they've been in terms of the more personal computing side, they've been trying to have a very consumer, like pro-consumer look and brand image. I think they could have pulled it off. I think they could have done a good job. And there's obviously a lot of integration they could have done in terms of its Xbox scene, and even some rebranding potentially even on its consoles in terms of Xbox Party Chat can now be Discord chat. There's a lot of different areas that I could have seen them going. Quick thing to note, of course, is that while the talks have ended and Discord has decided to end the talks and pull out, it was noted that they left this on the table in the sense that they are thinking of potentially going back to this conversation. But yes, at the moment, it fell through. I think, at least looking from Microsoft perspective, that's definitely a shame, because it's a wonderful service, and I think it holds a lot of value, more than a lot of people think.
Thank you.
Of course.
I have two questions.
Sure.
So the first is that, the hottest topic on Wall Street right now is a chip shortage, of course. I was wondering how, what Microsoft is going to do with that. I know that you mentioned about the ARM chips, but most importantly, like how fast are they to execute their ARM chips and put it in their computers and their gaming consoles. And also, the next question is, I just saw I lost my train of thought. But you can ask the first question first, and then I'll share.
Of course. Yeah, so look, shortage is a big deal, and again, it's cutting into a lot of potential revenue. And I think a lot of companies have become frustrated with, if you're not Apple, you're basically depending on Qualcomm on the ARM area. A lot of companies want their own silicon because there's not a lot of competition there. Samsung, I know Google's working in partnership with Samsung. They're one of the only companies that do their own chips. They do Exynos, which have recently caught up to Qualcomm. And Microsoft wants some of that too, because Apple is killing it with M1. I don't use a Mac. I don't really like the device too much, but they've been killing it. And there's not really a second place. It's that far apart. And so they're definitely going to go for it. So to answer the actual silicon shortage question, this one's interesting. A lot of people think that, obviously for a long time, the supply lines were cut off a bit, right? They couldn't manufacture as quickly. That's been mostly resolved. The real reason now at this point, I was watching an interview with, I can't remember who, going over this. The real reason is that we just keep buying. The demand really is that high. And a large part of it is that, especially when it comes to GPUs, is that people are realizing, especially during the pandemic, companies and individuals are realizing, holy crap, everything is out of date. This is not working. And so there was a rush to upgrade everything. And that's led to a lot of demand and difficulty in terms of keeping up with supply. But we'll see how things pan out. Of course, Microsoft, I think they should definitely continue to push on their own silicon. I think it's a massive advantage for Apple. I think it'll continue to be a good advantage for Samsung, and eventually it'll be a massive advantage for Microsoft and other companies if they can get to the same level.
That was great. I just remember my question. It was Microsoft has a lot of cash on their balance sheet, over $1 billion, or quite a lot. Is there anywhere in their earnings report or 10K that says what they're planning to do with all their cash, like acquire a company, spending on working capital?
I was gonna say, I think they've shown us what they want to do, and they've been acquiring companies left and right. So going off of that, yeah, I think they're really looking to, again, they're really doubling down on their IT section. They're really doubling down on their cloud computing section. And I think they're going to continue to do that. I think they're going to focus. This is Al's future predictions. Again, they're going to continue to focus on cloud, and I think they're going to continue to focus on turning gaming more into a service, and really hedge on that being a future massive revenue maker. And to be fair, it's grown considerably. And I think as Game Pass becomes more popular, when more consumers get their hands on devices, that'll grow as well. But yeah, I think they're keeping a lot of cash on hand for acquisitions.
Awesome, thank you.
I do have a question.
Sure.
Well, I guess like first just want to touch a point about how you talked about how GPU was like booming, and well, I guess like one thing beside for like personal use and like upgrading company stuff like that, I think one of the reason why it was like so demanding right now is the rise of crypto as well, because a lot of
Yeah.
people use that to mining crypto, so that kind of draw a lot more demand. And yeah, like you see like during the pandemic, a lot of crypto just literally just boom in price. So that's what another reason why GPU was super demanding. And well, that's just like my opinion on that. That wasn't like any question or anything. Um, but oh, the question I have was kind of similar to Joe. It's basically about comparing like between AWS and Google, not Google, Microsoft like cloud service basically. Because I know a lot of company and like software um is rely on AWS to run its entire server. And you know, like changing from server to server is one thing, but like how how would it keep like the same performance? Like how would Microsoft will be able to like convince them to like change that what have been working so well to like an entirely new thing? Would yeah, like they will basically kind of like um risk a performance factor. You know, like people say like don't break, wait, no, don't don't break.
If it's not
It,
broken, don't
If
fix
it
it.
ain't broke, don't fix
yes,
it. Yeah, yeah.
yes, if it's not broken, don't fix this kind of thing. So it's like um yeah, like changing from AWS to Microsoft will require a lot more than just changing the number in price.
Yeah.
Like performance wise, like there's so much more into it. Like how do you think Microsoft will be able to like convince those company to change its core, like everything, basically like everything that is rely on into like a new home basically?
The best answer I have for that, and I'll answer this question first and go back to what you were talking about in terms of GPUs, even though that was, of course. But I think Azure is one of the other advantages that Azure has is that it's open to hybrid cloud systems, and AWS is not. They're not open to private third-party cloud computing, and so what I mean by that is that maybe for some companies it might be that Azure is just the best company in terms of supporting their infrastructure. And so they see that benefit and that, that cost benefit. It's not necessarily just about the way they charge, although Azure does charge, for example, per minute. I know AWS charges per hour, and so companies prefer that. That pay as you go benefit as well. So it's not just necessarily that it can be cheaper, but it also just might be more capable for what you need. If you need that hybrid cloud system, then you're going to go with Azure because AWS doesn't let you do that. To go to your GPU question, to your GPU point, fully agree. I forgot to mention that, but yeah, crypto absolutely has been a big deal. And it's also been interesting to see how companies have responded. NVIDIA making cards just for crypto computing, and that's going to be interesting to see as well. So of course, yeah. So we'll see what happens there. But yeah, I mean, NVIDIA's making their own cards, trying to benefit from the influx of cloud, of crypto miners. AMD hasn't quite done the same thing, but that has been leading to, especially with GPUs, a major shortage. That there was already a silicon shortage because of demand ongoing. But you're totally right. GPUs are just extra hammered down because of crypto mining.
Yeah.
I have two questions. So first question, because your recommendation is a buy, so what do you see that other analysts don't see? And the second question is that in the presentation, you mentioned that Microsoft have high ESG score, especially the governance score. So can you explain more on that?
Yeah, okay. So to go off of the first point, sorry, can you repeat your first question one more time? I'm sorry, I'm a little tired.
Yeah. So you recommend, your recommendation is a buy.
Yes.
Yeah. So what do you see that?
I was just gonna say I think I'm hardly alone on it in the sense that I think most platforms are mentioning it as a buy over like a hold, for example. So I think I'm hardly alone here. I think a lot of analysts are seeing Microsoft's move towards, and look, when you look at its numbers in terms of its growth for its cloud computing, it really is amazing. Like it's genuinely like astonishing how much they've shaken up the and cut into other companies. AWS a little bit, obviously not too much impact, but they've really set themselves up as the second like dominant cloud provider there. Before it was like the big three, Google as well. And now it's really looking more like Microsoft and Amazon is the big two, and then everyone else kind of there. So I think that's the big thing on that end. And then in terms of its ESG scores, I know for trying to think broadly, but I know for its environmental scores, for example, Amazon was the first company to state that it was going to go carbon neutral by 2030. So that was one of the big things in terms of its environmental score. Governance, I think it offers a lot of transparency in terms of the way that the company is run, more so than a lot of other companies do, and so that's been very beneficial as well in terms of Microsoft score.
Cool. We'll wrap it up soon. I think we have time for one more question if we have any from the audience. Going once.
I got one last question. So Microsoft you're talking about Game Pass. Video game is definitely one of the biggest market in the future. They definitely have a lot of competitors. Sony is definitely one of the biggest one. Tencent is also in computer gaming. They are going crazy with Fortnite. Also, Riot Games is also a big. So like, what makes Microsoft how is Microsoft going to compete with that? Because Sony has a Spider-Man. They have exclusive game for them. I just don't see as Microsoft haven't see them performing that well as making a new game that is really a lot of people is playing besides Minecraft like that. So will that be a big problem for the company?
I'm actually going to quote something that Microsoft said a long time, or not paraphrase specifically, but a long time ago they said that they were looking at their competitors, and they were talking about Xbox at this point. Their competitors such as like Google, Amazon, which were left people confused. Like, why is Sony not included in that? And again, the big reason why is that it feels pretty clear that Microsoft they're not really thinking about dominance in terms of like console hardware at this point. They're just thinking subscription. And I think for a lot of people, they've been seeing subscription-based gaming and cloud gaming as like a potential future, or just having that subscription model where you can play as many games as you want for a certain amount of money a month. And to that extent, they don't have to compete in some areas. People were saying, well, Microsoft doesn't have exclusives. Like, you can just play all their exclusives on PC. Microsoft owns all, they own Windows, so they don't really lose out on that. They don't care. You still end up buying from their subscription. You still end up, giving them their revenue. So Microsoft on that end doesn't really give a crap. Like it's just, they end up getting that revenue in either case. Whereas like Sony's kind of playing the shorter term, Microsoft's really betting on this long-term infrastructure and having this consistent revenue and having it just kind of transcend just console gaming, but hardware-based console gaming, but also going into some potential future devices. Maybe there's like something like a Chromecast where you clip it in the back and it's not Stadia, so it doesn't suck. And then you have you can play games from there. Or maybe you have, continue to see Game Pass Pro on PC, which could disrupt Valve's, Valve's dominance that they've had there for a long time. So if they're able to disrupt Valve, that's another competitor that Sony isn't even thinking about. So to answer your question, they're not necessarily focusing on Sony. They're focusing on broader, I guess, dominance, or just bringing in revenue from different sources.
Thank you all for a wonderful presentation, and thanks everyone for asking questions and participating. We are going to announce the winner for the Kahoot game. Bear with me for a second. Drum roll, please. Third place is Dave. And the second place is Tina. The first place is Boston. Congratulations to all three of you. Please reach out to me. I'll leave my email, Seattle U email address on the chat. And this wraps up our investment series. Thank you all again for joining us. It was an honor to present to all of you, and have a wonderful week.
Do you want to mention the hiring process, the job hiring?
Oh, yes. The Red Dog Fund is hiring, as you may have heard. We are open to applications till May 3rd. Please refer to the email that you may have gotten. If not, please contact me or Professor Kathy Cow for more details. Thank you all.
Thanks for coming.
I got a question for the professors. So I'm not a finance student, and I'm currently struggle with paying off my car loan or max out my Roth IRA. What can you give me a choice of, like, what should I do?
So, sorry, what's your question? How to finance your tuition?
No, like should I choose Roth IRA or should I choose paying off my car loan? Because both of it is around 6K.
Really depends on how what's your investment return, in my opinion. So if your investment return is lower than the interest rate charge on the loan, you should pay the loan first, right? It's more like you're doing the margin purchase, you borrow the money, then do the investment. So if your investment return is higher than the borrowing rate, then you should invest more in the stock, in Roth. But if the opposite, it's better to pay off the loan. So it's not an easy answer. Really depends on what's your average return.
Thank you. That was my question. Yeah, because I'm currently stucking with this in my mind for a while, and I wasn't sure who to ask. So yeah, thank you guys so much.
Thank you for coming. But one thing to add, so I would highly recommend everyone at least know how to do the personal investment. It's very important to like how do I say, help your